What's up, traders? It's Sunday night. It's time to look at all the markets and see where the support resistance levels are that I want to trade and I think is going to be a good place for opportunity. Really and truly, from last week until this week, we have remained on most assets inside a range. Things are starting to tighten together, things are starting to consolidate, and this is normal for this time of the year. We are getting out of the high volatility, high volume, big range periods of the early part of the year. That doesn't mean there's no more opportunities. It's just the ranges are going to get a lot smaller. And then we'll have to wait for an explosion of volatility at some unforeseen time. But that's what we're going to try to find where those explosions might happen. Let's start off with cryptocurrency first. So, if you've been watching these weekly videos, you know that Bitcoin is still holding its support at 36K. This is the weekly support. This is where the all time high to the March of 2020 COVID low marks this line in the sand right here for us. And we are still waiting to see if Bitcoin will break to the downside or if it can break to the upside. Either one is going to be a breakout that will determine the direction in my mind. And so a breakout of 46K or a breakout of, let's call it 34 into the 30s, that is going to determine where Bitcoin and likely the direction of crypto as a whole. Ethereum doing much the same thing, consolidating tighter and tighter and tighter into a range. Let me tell you something about tight consolidations. Price has a tendency to abhor them. It wants to break out of them. Now, you don't know when exactly, but you know that price will continue to squeeze, squeeze, squeeze. And the longer that price squeezes, oftentimes, most of the time, the bigger the move out of it is. So don't get sleepy. Make your alerts on major lows, like in Bitcoin. Set the alert below the low that it made on the 24th of February and the low that it made on the 4th of January. Also set it for the highs that it made on the 10th of February and the 2nd of March. Basically, you want to know when price is getting up and breaching those levels. That's going to give you a good insight into where it's going to go next. Bitcoin dominance has kind of fallen off a little bit, but continues to be in an uptrend. And that's important because as we look at the Bitcoin crosses, while they're not going to crazy lows, they are still trending downward slowly. I think one of the ones we looked at last week, which was Solana BTC, this is my example for some friends that are long Solana. I recommend they look at to hedge their existing exposure from last week when we talked about this, March the 6th, where we were holding these lows basically at point, I hate so many zeros, 0.00217. That has broken, and now from last Sunday's weekly levels, that's about a 5% gain, minus 5.6%. That would have been a gain if one had gone short and not had to bet against, not would have had to sell their Solano. Solano itself, which I am watching actually, Solana USD, it is getting close to this breakout level of the February the 24th low right down here. So if we break this February 24th low outside of this little consolidation that it is caught in, and tonight got a couple of volatility alerts on crypto. Looks like the market is a little down going into the week today. Crypto, and we're going to get to stock equities in just a second. But yeah, crypto is taking a little bit of a nosedive tonight, Sunday, really getting close to those lows. So have your alerts set and watch out. Dollar continues to trend up. It maintained its uptrend. So we do not see hyperinflation just yet. Let's look at the stock equities. Well, As I've said since we made the 24th low, this is a key setup to retest the high. Now, I change my sentiment on the stock market equities if they break the February 24th low. I've gotten a lot of private messages, DMs this week from friends and people on my Discord or follow me on TradingView asking me, have you changed your opinion? Because, yes, the market has come back down into this danger zone. We probably should have held this level right here, February 28th, March 1st, and March the 2nd. We probably should have held as we did, boom, 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 this level on, let's say, the SPY 429, and the NASDAQ would have been about 13,800. We should have held that level if we wanted to see some kind of a rocket up V bottom off of this low. But we've instead come back down into this danger zone. And if you'll notice, we actually have come back down on Friday, and we held it from the top side. So that 429 is now resistance. The February 24th low is going to be the final support. And once again, we're caught within a range as price tends to slow down. And now we're getting into this really tight, narrow range. Again, price likes to break out. And the longer it consolidates, the faster the move tends to be. So this week could be either just a continuation of this squeeze as we push off the breakout to another date, or we could see a breakout of these levels. So I would set an alert above the Friday high of March 11th. And then, of course, you should already have your alert for the break of the February the 24th low. That is going to tell us which way this is going to go. VIX has done something interesting, and I've talked about this in my live stream on Friday. Normally, what the VIX likes to do is shoot up very quickly and then fall off very quickly. You saw that in pretty much every single little market volatility event. VIX likes to shoot up when the market goes down and then quickly fall off as the market slowly goes up. Well, in this January the 24th, we saw that where it shot up very quickly and then came back down to a low on February 9th. And then as we started to get more fear in the market because of the Russian invasion, up it goes. And it made another high on February the 24th on the Russian invasion. But this high on the VIX was a little bit lower than the January 24th, even though the drop in the market was lower. So there's a divergence. Normally, you would see if the market went lower, VIX should be higher, but this is a divergence. And so that is a bullish sign. And then recently in the past week, on March 8th, which was Tuesday, VIX came up and made another high, which wasn't quite as high as even the last one. So we have declining highs on the fear index, on the volatility index. But while this was going on, VIX was not really doing that quick fall off that we can normally see if we look back at every single event in history. Instead, it was sort of creating a little channel. And then finally on Thursday and Friday, we broke below that channel. VIX volatility is falling off. So the VIX is telling us bullish. The VIX is telling us that we should not break the February 24th low, but that can all change. If I'm going as VIX as a guide, we have the divergence of the highs on VIX. We also have finally breaking this trend up in volatility. The VIX is at least telling us bullish. So that's it. Gold. Let's look at the commodities. I know a lot of friends of mine have been trying to play this breakout of gold. I'm pretty sure that the breakout of gold began sometime in late February. I think it was part of the Russia trade. And so people that are getting it right now, originally I thought that this could have been a false breakout on gold, but instead it actually pushed a little higher into last week. So good for the people that are going bullish on gold, but it has also fallen off. The reason I didn't necessarily like the gold trade as it were was not that I didn't think that it could go up, it's because of the risk reward. To get back up to this last high, the all-time high in gold from the breakout level, which I believe a lot of people were trying to go long from 119, or excuse me, 1913 up to here. There's good money to be made up here to 2090, yes, but you had to take on the risk of this falling off. But now you're getting rewarded for taking that trade. So gold still needs to break this past all-time high at 2090 an ounce. We're looking at futures, by the way, but it is still in this bullish range. So be very careful as price makes another attempt up here, and be sure that it does. Be very, very careful with gold as it's doing this pullback. You've got to close below the Tinkerson. That's your first sign that it's not quite as strong a trend. Silver, this is a breakout trade that I did actually take. And the reason for that is because on a percentage basis, on a risk reward basis, there was just more room to get up to the top here. And that was what triggered the breakouts. It's still live. The breakouts on gold and silver are still live. Just need to watch and see if it actually kicks off a sustained trend or, again, if this is a false breakout. So far, the weekly closes are telling us that we are closing higher. So we're slowly making our way up there. But it's precious metals. They don't move that fast most of the time. Oil. I think a lot of people are trying to fade this move on oil. Oil is a volatile commodity. I think some people are trying to actually look at oil to hedge their gasoline. I saw an article that gas was at $8 a gallon in California. Jeez. As I've told people that have asked me about gas prices, what I remember happening back in my early days as a trader, uh, go oil tended to range between about 110. This is back in the early the aughts. No, excuse me, the teens. Sorry, the teens. So back in the teens, oil tended to trend between about 110 and 90. And it did that from about the period of February or it was 2011 until it finally broke out in 2014. And so around this period is where a lot of US shale production really came online. That's why we had the big fall in oil prices around 2014, is because the United States actually became energy independent with our shale production out in our Midwest and central part of the country. And so that production drove the price of oil down because the supply came up. And then, as sort of a little political move, OPEC, what they did was they decided to drive up production to take some of these shale producers, their competition, out of business. And that is the whole story of this run down to $0 a barrel. Now, oil at $0 a barrel was probably the most obvious trade of our lifetime. And I was able to capture it, but not this full amount right here, not the full amount. I thought we would top out somewhere around 100 because it's in the middle of this range, but eh, that's what happens when you take profits. You should always be taking profits too early instead of too late. So, what I expect is this to actually have been a blip. I think that a lot of oil producers are going to be coming online. I think that supply is going to be coming into the market, and probably price for the next few years will once again enter into this sort of equilibrium of supply and demand, which means that gas prices are probably going to stay no less than 350, maybe around 450 once this all settles out. And so, to my friends that are driving a lot and trying to consider the next few years, I would say expect this price of gas to be the norm, uh, and choose your vehicle accordingly. Maybe you do need to start looking into an electric car. I know I will. Wheat and corn, more of these war trades. We had a fall off, as you normally expect from a parabolic, and same goes with these. I think it would be very hard to get short these commodities, but in the case of wheat on the daily, you do finally have a close below the Tinkinson. Now, what I would look to do if I was going to short something like this, is I would take a look from the high that it made down to this reaction. This last week of price action. Now we're getting into something that we can follow as these weeks go along. I don't want to try to short it at the high because you don't know where that's going to be. So at this point, if we could pull back, and I'm using wheat, this is the ETF. We'll just use this instead of looking at futures. What you want to do is you want to look for maybe a halfway pullback somewhere in the 11-19 range. And then that would be a much more high probability setup than trying to pick places along the run up. Yes, if you were able to capture a short on the way up and get lucky, good for you. But what I would wait for is some kind of a price reaction, some little bearish movement, set you up with an entry level, and then try to play the move back down, as all parabolics tend to do. Corn, if you notice, it has actually in this last week held the red line. And so this is why you have to wait until you have a close below the Tinkinson. This is the Ichimoku Tinkinson, by the way. That is your first sign. You had it back here. Maybe you could have taken a short right here. Oh, well. Now it's coming back. So now we should get some kind of, it should continue actually upward because we're still holding that red line. So this is why I would not want to short corn going into this week. Apple is doing much the same thing. Look at stocks now. Apple is doing much the same thing as the rest of the market. That February 24th low is all important. Meanwhile, it has held itself to the upside. Apple, just like the market, is caught within a range. Tesla is still being a little dangerous. It didn't quite get back up to that 900 level. Remember, this was the key level to go long back in December. It was the former all-time high, and it came back up at the end of last week. Was that March the 2nd? Yes, around middle of last week, came up and held. Yeah, I'm out of Tesla, and I'm just watching it now. Facebook can't possibly go lower, or can it? Waste management, it is recovering but holding its resistance, but still a good pick. Google, my highest conviction trade of the year, also needs to hold the February 24th low. We're holding out here pretty well. Finally, Amazon. Now, this is a painful, painful mistake on my part, not because I lost money, but because I lost an opportunity, and not because I did something wrong, because I was just not diligent enough. All I sit here every week and talk to you all about is setting up 50% retracement levels. And I had all past 6, 7, 8 months to draw a 50% retracement level on Amazon from the all-time high on the 13th of January, 2021, down to the COVID low. So this is a major 6-month. This is a major high and low for like the past 2 years. I had 2 years to set this up, and on January the 24th, if I had had that alert, it would not have triggered. But if I had had it on March the 8th, Tuesday of this week, Amazon would have hit this alert. I would have been able to buy it. I would have also had confirmation, because if you notice this candlestick, it closed to the closing bar of that day, March 8th, held the January 24th low. It also held the 50% retracement. That is a great close. That is a confirmation of the level to me. That is a good sign to get along. And if one had, they would have been in Amazon before they announced the split. Now, if you know from Google, one of my highest conviction trades of the year is because when things split, there tends to be, at least over the last couple of years in tech companies, a FOMO rally. The split is on May the 27th. So there is time between now and May to be looking for a setup. I certainly will. I think you will too. But sorry I didn't bring this to you guys. Now you know. Thank you. I'm running out of time here. My 20 minutes on this. Have a good week. Trade wisely. We'll see you in the next video.